Here's a number that should stop you cold. 89%. That's the share of first-time homeowners in America who say the ongoing costs of their home were more expensive than they expected. Not a little more expensive. Jaw-dropping, budget-wrecking, nobody told me this more expensive. And the crazy part? Most of them did their homework. They knew their mortgage payment, they saved their down payment, they ran the numbers, or at least they thought they did. But here's the problem. The mortgage is not the cost of owning a home, it's just the entry fee. The real bill comes after you've already signed. Today, we're running the full forensic math. Every hidden cost, every fee, every annual expense that your lender, your realtor, and every How to Buy a House YouTube video conveniently skips over. By the end of this video, you'll know the true total cost of owning a median American home in 2026, not the advertised cost, the actual one. Let's establish our baseline so every number we run is grounded in reality. As of April 2026, the median existing home price in the United States is $417,700. That's according to the National Association of Realtors, the most current data available. The average 30-year fixed mortgage rate right now sits at 6.36% per Freddie Mac's latest weekly survey. Most people, when they talk about what a house costs, are thinking about the monthly mortgage payment. On a $417,700 home with the standard 20% down payment of $83,500, your monthly principal and interest payment comes out to about $2,082 a month. That sounds manageable for many households, and so people say, I can afford that. But that's not your housing payment. That's just one line item on a much longer bill. Let's go through every single one. The first cost hits you before you even make your first mortgage payment. Closing costs, the fees to actually complete your home purchase, run between 2% and 5% of your loan amount. On our $417,700 home with a $334,200 loan, that's anywhere from $6,700 to $16,700 due at the closing table. What are you paying for? Loan origination fees, title insurance, appraisal, home inspection, recording fees, prepaid taxes and insurance, escrow setup. The national average lands around $6,800 to $7,000, but that's the low end. In a state like Delaware, buyers are paying over $29,000 in closing costs on a similar home. In Washington, D.C., it's nearly the same. This is money you need in cash on top of your down payment. So your true upfront cost to buy a median American home isn't $83,500. It's closer to $93,000 to $97,000 minimum before you own a single square foot. The second cost is property taxes, and this one is permanent. It doesn't disappear, it doesn't shrink, and in most states, it's been going up. The national median effective property tax rate is 0.89% of your home's assessed value per year. On our $417,700 home, that's roughly $3,700 a year, or about $308 every single month. But in New Jersey, the highest taxed state in the country, the effective rate hits 2.23%. On our same home, that's $9,300 a year, an extra $775 a month just in taxes. Hawaii sits at the other end at 0.27%, about $1,100 annually. But Hawaii has its own affordability problems we don't need to get into right now. The point is that property taxes in most of America represent a second mortgage payment that never ends, never builds equity, and goes up over time. Between 2023 and 2024 alone, property taxes on single-family homes jumped 6% nationally. In Louisiana, they jumped 18% in a single year. The third cost is homeowners insurance, and the market has fundamentally changed. Everyone knows you need it. What most people don't know is how much it has changed in the last 4 years. Nationally, homeowners insurance premiums have risen nearly 70% since 2021. The average annual premium now runs between $2,800 and $3,550 per year. That's $234 to $296 a month. But if you live in a high-risk state, the math gets brutal fast. Florida homeowners were paying an average of $9,376 a year for home and flood insurance combined. That's nearly $800 a month just in insurance. Insurers have been fleeing those markets entirely, leaving homeowners with state-backed last resort policies that are more expensive and cover less. The reason for the national spike isn't just inflation, it's climate risk. The growing frequency of hurricanes, wildfires, and flooding has made underwriting American homes dramatically more expensive, and that cost gets passed to you, the homeowner, every single renewal cycle. The fourth cost is maintenance and repairs, and this is the one that quietly breaks budgets. Unlike a mortgage, it's unpredictable. The standard rule is to budget 1 to 2% of your home's value per year for maintenance and repairs. On a $417,700 home, that's $4,177 to $8,354 a year, or $348 to $696 every month. Some years you'll spend less, but some years you'll spend a lot more. A new roof runs $9,000 to $15,000. HVAC replacement, $5,000 to $12,000. Water heater, $1,000 to $3,500. Plumbing emergency? Unpredictable. A Zillow and Thumbtack analysis from late 2025 found that the average homeowner spends $10,946 a year on maintenance alone, more than any other single hidden cost category. That's not a renovation, that's just keeping the house running. Renters don't pay this. It's one of the structurally underestimated advantages of renting that almost nobody talks about.
The fifth cost is utilities. And the number is bigger than most people expect when they move from renting to owning. You paid for electricity and gas as a renter, but you almost certainly paid less because you were heating and cooling a smaller space with no yard, no garage, no basement, no second bathroom. The average homeowner pays $5,465 a year in utilities, electricity, gas, and water combined. That's about $455 a month. And that figure is rising fast. Electric bills are up nearly 30% since 2021. Natural gas bills have risen 40% since 2019. Both are outpacing general inflation, driven by transmission costs and grid maintenance, not just energy prices. If you're buying an older or larger home, expect to sit at the high end of that range or above it. The sixth cost only applies if your home sits in a community with a homeowners association, and 29% of Americans live in one. HOA fees are mandatory, recurring, and largely outside your control. Median annual HOA dues jumped 44% in 2025 to $757 a year, up from around $500 where they'd held steady for years. Monthly, that's roughly $63 at the median, but in many communities, especially condos and newer developments, monthly HOA fees run $200 to $500 or more. And then there are special assessments, one-time fees your HOA can levy when something major needs to be fixed communally, a new roof on the building, parking lot resurfacing, structural repairs. In 2025, nearly 10% of all HOAs issued a special assessment, with a median bill of $1,100. That can show up with 30 days' notice. You don't get a meaningful vote, you just pay it. The seventh cost only applies if you put down less than 20%, which on a $417,700 home means anyone who didn't bring $83,500 in cash to the table. Private mortgage insurance, or PMI, is insurance that protects your lender, not you, in case you default, and you pay for it. PMI typically runs 0.46% to 1.50% of your loan amount annually. On a 10% down payment scenario, putting down $41,770 on our $417,700 home, your loan is $375,930. PMI adds $1,730 to $5,639 per year, or $144 to $470 a month that builds zero equity and protects someone other than you. PMI disappears once you hit 20% equity in the home, but at a 6.36% interest rate with a modest down payment, that takes years. Now let's put the whole picture on the table. You buy the median American home, $417,700, 20% down, 6.36% rate. Your mortgage principal and interest is $2,082 a month. Add property taxes at the national average, and that's another $308.
Homeowners insurance adds $263. A maintenance reserve at 1.5% of home value adds $522. Utilities add $455. That brings your true monthly cost of ownership to $3,630 without HOA fees. If you're in an HOA, add anywhere from $63 to $300 or more on top of that. Your realistic range lands between $3,630 and $3,930 a month. Annually, that's $43,560 to $47,160, and that's on a home you put nearly $100,000 down on upfront. The mortgage payment people quote is $2,082. The real number is $3,630 minimum. That's a 74% gap between what people plan for and what they actually pay. And that gap right there is why 81% of homeowners say costs exceeded their expectations. This isn't a flaw in the math, it's a feature of how home ownership is sold to you. None of this means buying a home is the wrong move. It can still be a powerful wealth-building decision, depending on your market, your timeline, and your financial situation. But here is the framework you should actually be using. First, run the full number, not the mortgage number. Take every line item we just covered and calculate what your specific home in your specific state will actually cost per month. Then ask whether that number, not the mortgage, fits your budget. Second, factor in opportunity cost. The $93,000 to $97,000 you're putting up in down payment and closing costs, what could that capital do if invested? At a 7% historical market return, that's roughly $6,500 to $6,800 a year in foregone investment returns. That's not a reason not to buy. It's a cost that belongs in your calculation. Third, check whether your market is overvalued. As of April 2026, 70% of the nation's 100 largest metros are considered overvalued, according to Collity's Home Price Index. Buying into an overvalued market on a 6.36% mortgage limits the appreciation buffer that historically made homeownership such a strong financial move. This doesn't mean wait forever. It means go in with eyes open, not based on what your lender pre-approved, not based on what you can technically afford, but based on the full, honest, brutal math of what you're actually signing up for. If you watched the last video on whether to rent or buy, this is the part 2 nobody makes. Because knowing whether to buy is only half the equation. Knowing the true cost of buying is what separates the people who build wealth through homeownership from the ones who get eaten alive by it. Most people will watch this, nod, and then go back to thinking about the mortgage number. Don't be most people. The math doesn't care about your feelings. It doesn't care what your parents told you. It doesn't care what your realtor says is a great deal. It only cares about what you actually put in and what you actually get out. That's all this channel is about. If that's the kind of content you want more of, no hype, no gurus, no shortcuts, then subscribe. It's free, and it might be the most valuable thing you do today.